Good afternoon. This is Sean Golding with Golding and Golding, here to discuss a very common issue, a late filed Form 3520, and the penalties that follow. In recent years, the IRS has significantly increased enforcement of offshore reporting for international information returns. The common terms you normally hear or acronyms are FBAR, Foreign Bank Account Reporting, FinCEN Form 114, or FATCA, the Foreign Account Tax Compliance Act. But the gift from a foreign person penalty is actually sometimes the most extreme penalty that the IRS issues, and it appears as of recent that they've really ramped up enforcement and issuing automatic penalties. So when a person is a U.S. person and they receive a gift from a foreign person, there may be a reporting requirement. One important aspect is that it doesn't have to be a foreign gift, it has to be a foreign person. There are three thresholds, whether it's a gift from a foreign individual, gift from a foreign corporation or entity, or gift, quote unquote, from a distribution from a foreign trust. So the Form 3520 is used to report either a gift or a series of transactions of gifts that exceeds the threshold. So the most common one and the least complicated is when there's a gift from a foreign individual. Common situation is there is a visa holder who meets a substantial presence test, a green card holder, or a citizen that has foreign parents. Oftentimes, with our caseload, it's Taiwan, China, India, the UK, Australia, Switzerland, etc. And there will be a gift from a foreign person, such as a parent, in order to purchase, let's say, a home in the United States. The U.S. person child, adult child, may not have the credit necessary yet to qualify for a mortgage. The parents have some money, so they gift the child the money. The child doesn't think anything of it because there's no income, so it doesn't go on the tax return per se. And next thing you know, a month later, maybe a couple years later, they learn a Form 3520. They file it late. They get hit with a 25% penalty on the value of the gift. Another type of reporting is when you receive a gift from a foreign entity. Now, the threshold requirement for having to report a gift from a foreign person, individual, is $100,000 in a given year from the same person. Either one gift, $150,000, or let's say a series of transactions, 12 gifts throughout the year for $10,000. It's not per gift, it's per year, person, series of transactions. When it deals with a foreign entity giving the gift to the U.S. person, the threshold drops significantly. It's like 16,388 or 888. It's an odd number, just shy of $17,000. If a U.S. person gets that kind of gift from a foreign entity, they have to report as well. Now, the reporting when you receive a gift from a foreign entity is more detailed. You have to identify who the gift came from, the name of the company, things like that. Taking a quick step back, when a U.S. person receives a gift from a foreign individual, they just have to report the date or dates, type of gift, and value. They don't have even to identify who gave the gift. When foreign trust is involved, the reporting is much more complicated. Much more reporting needs to be done, kind of beyond the scope of this presentation, but just know that if you have a foreign trust, not really employment trusts, that's kind of considered duplicate reporting, and you generally don't have to report that. But if it's a foreign grantor trust and you're receiving a distribution as a U.S. beneficiary, U.S. person, there may be some significant reporting, more so than when you receive an individual gift. A common question we get is it include inheritance? And generally the answer is yes, even though technically the form may not say inheritance. Inheritance is a type of gift, right? So gifts can be very encompassing. What happens when you don't file the 3520? Well, there's various situations. A lot of times clients will come to us, we'll submit a reasonable cost statement package to the IRS to avoid the penalty. And almost always it's successful. It's not guaranteed, but for the most part, it's successful. Other times, someone will come to us and they went to a CPA, a less experienced attorney, doesn't really specialize in this area of law, and they kind of slap together a half thought out page, maybe reasonable cause letter, and they get penalized. Another common situation is they just file the 3520 late because what do they know? They're not tax professionals and their CPAs didn't give them the right advice. The form isn't even available in TurboTax, and they don't submit a reasonable cause letter, and then they receive a notice of penalty. If you receive a notice of penalty, oftentimes it'll be what's called a CP15 notice. There's a very strict time requirement to reply. It's normally 30 days. And that penalty, the ones that we see here are normally 25% of the gift. So if it's an $800,000 gift, $1 million gift, you're looking at a $200,000 $250,000 penalty when there's no unreported income. If there's more to it, like there's also maybe that gift was put into a foreign account, that foreign account is now generating interest, dividends, capital gains, then it becomes much more complicated, right? Because then you may have to do one of the voluntary disclosure programs because now you have unreported income, you have undisclosed assets and accounts, investments, and it becomes more complicated. The most important takeaway from this is if you receive a CP15 notice, you have to make sure you respond timely in order to preserve certain rights. My name is Sean Golding with Golding & Golding. We have lots of free resources on our main website, goldinglawyers.com. If you're interested in researching the streamlined procedures specifically, we have a sister website, irsstreamlinedprocedures.com. Thank you for your time. Enjoy the rest of your day.